Good morning, my name is Michael Pade. I'm standing in for Paul Kavanagh on April the 7th for this week's podcast. This morning we've got an announcement of a big merger in the cement sector with Holcim and Lafarge coming together. This will be the world's largest cement manufacturer and will require probably significant divestments in Europe, which will benefit our Killick recommendation breed and aggregate. So we'll be watching that closely today. On the forward-looking diary, the week ahead, we've got Alcoa starting the Q1 reporting season in the States. Of the Killick list, we've got Samsung reporting on Tuesday, we've got 888 reporting on Thursday, and we've also got Wells Fargo reporting on Friday. We've also got Marks & Spencer's coming in with an IMS on Thursday, going into that with fairly negative analyst expectations on those numbers. On the economic diary, Wednesday we've got the FOMC minutes. On Thursday we've got the Bank of England rate decision, and on Friday we've got some more CPI data, inflation data from Europe. So what's been going on in markets? Well, at the cyclical end of the market, those sort of stocks have been performing very well against the main market. So that is a sign that people are getting incrementally more positive on the earnings and GDP outlook for the US and for the UK. In that sort of position, we start to see consumer stocks starting to outperform. So you've got the retailers, the banks, the white goods companies. And this is a sign that individuals at the consumer level are becoming more confident. Their balance sheets, the personal balance sheets have been repaired, and they're going out and spending incrementally more. At the corporate level, we're also seeing an uptick in some of the capex stocks. To date, we've seen management teams being incredibly cautious about their balance sheets. They're using free cash flow to repair their balance sheets, to increase their dividends, to buy back shares. They're now in a position because to date we've seen margins expanding as a result of interest rates going down and wages staying pretty constant, where they're going to have to start investing in productivity. And to do that, they've got to spend on capex. So we're starting to see shares in some of the chemical businesses, the air separation business. We've got a new recommendation in Linde this morning that came out last night, back end of last week. Some of the trucking stocks, some of the telco equipment stocks starting to perform well in this market. The sort of other side of that is that some of the other growth stocks that previously investors have been going to for growth, such as the internet or the biotech stocks, they've been performing quite badly in this tape. And that's been a rotation out of those growth stocks into the cyclical stocks, the cyclical names, so you can get growth at a cheaper price. So growth is less scarce in this kind of market. Also, the other issue for internet stocks is they act like a long bond, a long-dated bond in this kind of environment. So you see interest rates potentially will rise as wage inflation starts to come through the system. And therefore, if your share price is the present value of all future revenues, then you see the discount rate of those future revenues start to get higher. Then the further off your revenues are as a company, the more that discount affects the present value of the share. So that's one of the reasons why the internet stocks and the biotech stocks have been weak, but the overall market has been moving ahead as growth expectations have got better. So how is that sort of changing growth expectation affecting the yield curve and the interest rate environment? What you can see here is the US Treasury yield curve. So since March, expectations of interest rates have gone up. So you can see that yield curve steepening, and that's a sign that growth is coming into the system. What is interesting is that at the very short end, it's remained anchored at very low rates. So this is really partly because of what Janet Yellen said last week in Chicago. So following her first Fed minutes and first press conference, following her first meeting at the FOMC, she felt that there was a market misunderstanding of what she said. So last week she went to great lengths to convince the market that they remained extremely nervous about the employment situation and unsatisfied with where they are in terms of the labour market. So she went into some detail about the percentage of the unemployed who've been unemployed for over 6 months being unacceptable at the moment. She also talked about the Labour participation rate at 63% being as low as it's been since 1978. There was also drawing reference to the number of people in the employment market who are working part-time but would prefer to be working full-time. So that suggests that there's still some slack in the labour market, which is good for companies, because the slack will mean that wage inflation isn't coming through as quickly as might be anticipated. She also talked finally about the wage inflation and the fact that we've seen sub 2% wage inflation since the financial crisis, which is very low at this stage of the cycle. So again, it's been good for margins for corporates. So in a situation where you've got low wage inflation, low interest rates, and likely to stay low for a long time, yet confidence building about the outlook for the economy for Q2, for Q4, that's a very good environment for the cyclical names and the corporate capex names. Elsewhere in the market, we saw the Russian index recover from its lows as concerns over the Ukraine situation start to diminish in the market's consciousness. I think that will probably come back. And this morning there's more discussion about the sort of gas situation in Ukraine and Russia. We also saw European Eurozone CPI inflation continue to come down. So the ECB met last week. Mario Draghi again talked about quantitative easing. They haven't cut their headline interest rate, but they are talking about moving to other measures, and you know, we see the progression towards QE becoming more and more inevitable, which ultimately will be quite good for the market, we think. On the stock side, as I said, we've got Samsung this week. Samsung is for us a valuation play. There are two parts to the business: the DRAM memory chip part of the business, which we think is, you know, a good business. We've seen consolidation in that sector from 10 to 3 players. They've also got the semiconductor business, which is 60% of the revenues. That business, the market's got a very bearish view on the operating margin in that business, as we see more and more people coming into that space and competing away the margins that Apple and Samsung have enjoyed to date. We think the market number is probably a little too conservative in terms of where that margin erosion will go, but we'll be looking at the results this week to get a sense of that. Equally, a movement to listing an ADR will be good for the stock because it trades on the KOSPI, which is the Korean index, and it's a very material part of that index. We've also got 888, which we don't expect anything new because they had a trading update a week ago. But this business showed a very strong rebound in their underlying revenue growth. So we went from 2% in Q2, Q3 to 9% growth in Q4. We like this stock for its exposure to the US gaming deregulation, and within the UK it's a great way to play that. They've also got growing mobile space in the sports book, so we think it's an interesting business from here. And finally, we've got Wells Fargo. For all the reasons we've been discussing in this podcast, we expect these results to be pretty good. They're benefiting from uptick in confidence, uptick in consumer lending, uptick in corporate lending, and increased housing market activity. But as you saw from that yield curve, as the short end stays anchored and the long end starts to go up, you see margins expand for the banks. So they're paying at the short end on deposits, and they're receiving in terms of what they get from longer dated loans on that rising long end of the curve. So they look very well placed for the current environment, and we'll watch those results with interest. So that's it from me. Thanks very much.